Hey everyone, I hope everyone's doing well and had a good day. This is the overview of the Emini 5-minute chart for Tuesday, October 15th, 2024. So here's the daily chart. I talked about this at the end of yesterday's video, so I'll keep this brief, but I was mentioning that there's a danger to this bull breakout. It's a good looking bull bar, not a lot of overlap. It's a bigger bar than the past few bars, and it might be a late leg, maybe a third leg up. And when you look at the weekly chart, there's also an argument for a late leg there as well. And even in here, breakout, pullback, breakout, pause, breakout. So I thought it was dangerous for the bulls to be buying up here unless the momentum continued. The market's getting far from the moving average, but we've had a lot of trading range price action, tight trading range, possible final flag, bull breakout. We could easily fail and fall back to the midpoint of this trading range. So I thought it was more likely that there would be more sellers above yesterday's high. And I didn't know we were going to do this, but I also talked about how when you think about the market cycle, yesterday we had a bull breakout, spike in channel trend. Channels evolve into trading ranges. So I thought this would be a test target. And if this channel evolves into a trading range, which it does 75% of the time, then you'll say the trading range began over here. You can see when traders agree that this is no longer a bull trend and that it's going to be a trading range and that we might be high in the range, we can fall really quickly. Let me back up. So here is the sort of back half of yesterday, bull channel. And then into today, we had a tight trading range on the open. Breakout mode on the open. We're getting lower highs, higher lows. You can call it a triangle. And the market is fairly neutral. But when you consider the higher time frame context and what I said earlier, if the bull trend is going to continue, the bulls need momentum. And this is not momentum. So I did think there was a greater risk of a bear breakout today. And obviously, you get the strong breakout from bar 12 through 15. And I say it all the time, that's a strong enough breakout that it needs a second leg. Now, is bar 30 the second leg? Probably not. It's common to see breakouts get brief second legs shortly after the breakout, but this is really forming a low one on a higher time frame. And in reality, the market likes symmetry. So I'm not sure this is enough of a second leg after this breakout. We may have to pull back deeper and get a bigger high 2. So maybe there's a high 1 around here. The market pulls back for another leg. And then I may have said high 1, low 1 here, and then low 2 here. Bear breakout, pull back, and then there's your symmetrical second leg. So obviously, tight trading range on the open. Limit order market, okay to wait. And then you get bar 12, a strong breakout bar, breaking below many bars to the left, and reasonably good context for a major trend reversal. Follow through, bar 13. Probably sell the close, especially with the tail on the bottom of that bar. It might be a breakout pullback. Better to sell the close than below the bar. And strong enough breakout, there may be a measured move down. So here's a target for the bears. There are several targets, and many different computers will look at many different measurements. Here's a possible leg 1 equals leg 2 measured move. We broke below that one. We broke below the spike measured move. But I wanted to show what I'm talking about with the high 1, or excuse me, the low 1, low 2. So here's the bear breakout on, let me pull up the 30-minute. Here's the breakout. Bear breakout, we get an inside bar with a bull body. It's a low 1 short, not a very good trade. Low 1s typically pull back. You get a deeper pullback, and then traders look to sell a low 2. You have bears who sold down here, disappointed by this pullback. They'll look to get out, break even, and you can see they bought, and they'll look to sell a low 2. Low 1, low 2, and traders sell. You don't have to know that. When you look at a lot of charts, and a good exercise is to compare time frames. And I do that all the time. And I have this screen here, so I'll have different charts. Here's a 2-minute chart, 45-minute, and the 5-minute. And I'll look at anything and just compare the time frames. And I wonder, what does this look like on, here's the 5-minute, what's the 30-minute look like? What's the 1-minute look like? It helps you gain a better understanding of the price action overall, and it helps develop your imagination with reading charts and price action. I don't have much time for today, so let me go through some stop orders. Breakout mode on the open, I mentioned it's a limit order market. Some traders might buy above bar 4. It's a second reversal, double bottom. After a gap up, take a chance that we get a bull breakout, but obviously disappointing entry bar. It actually didn't trigger on bar 5, so maybe you buy above 5, you take a chance, but when you get disappointing follow through on 6, you probably just exit the trade either at break even or with a small loss. Then you can take a chance selling below 8. Good follow through, but immediately pulled back, breakout pullback, testing the breakout point. And then here, there's a low 1 short below 11, but not great. Tail below the bar, not yet high probability. 12, reasonable to sell below. Sell to close 13, sell to close 14, but then disappointing follow through 15. Sell to close bears get out on 16, we pull back. This pullback needs a second leg, and here's a second reversal. So there's a stop order scalp above bar 21, but it's just that, it's a scalp. You expect a second leg after that rally, but you look to the left, and this bear breakout still needs a second leg down. This is a minor reversal, big enough minor reversal for its own second leg, maybe even a third leg, in this case a truncated wedge. But don't lose sight of the big picture. There's you can call it a low 3, below bar 26. It's a good signal bar, context is good, sell below there. And then I mentioned that's a low 1 on a higher time frame. So we're testing an area over here where bears got trapped and the bears buy back their shorts. 32 is strong enough for a second leg. We pause, pull back, get a second leg. That might need a second leg, and in this case we got a third leg. It's a spike in channel, but it's minor, just like over here. You can see, even though we're getting bull bars, we're getting higher highs, higher lows. It's a spike in channel. It's a small pattern, and we're still not above the most recent major lower high, which you could say is bar 22. So until we break above there, the market is still in a bear trend. So then you get a low 3 on bar 38. That's a reasonable short, good entry bar. And if you're trading always in, where do you get out? You can get out above 50, but if you do, you get short again below a bear bar. So some traders might exit but then sell again below 52. Same thing here. Maybe you exit above 59 but sell below a bear bar. Didn't trigger. Do you get out above 62? You don't have to. It's a second reversal, but pretty tight bear channel. The market's in a fairly strong bear trend, and the signal bar is small. Unlikely to lead to a major reversal, so okay to hold short. Also okay to exit shorts, but if you do, you sell below a bear bar. So if you exited, you can sell below 64. Little climactic on 67 might be a profit-taking bar, breaking below the channel line. So it's climactic. You expect to pull back after that. Some traders will take profits. Not really ideal to sell, but it could be a measuring gap. And you can see we pulled back. Always reasonable to get out above a bull bar when the market is getting far from the moving average. The risk is big for the bears. We have a 6 or 7 bar micro channel, so in theory the bear stop is way up here. And if you're selling and you're going for 1 times your risk, realistically, just to break even, you need a 60% win rate if you're selling here with a stop up here. And that's just not, this is not a high probability sell. You're getting a climactic bar in a prolonged bear trend. This is either a measuring gap or an exhaustion gap, but you get a bar like 70, a bull bar closing on its high when the risk is big and we're getting far from the average price. Always reasonable to sort of just get out above bar 70. If you've ever heard Al talk about this situation in the trading room, this is sort of a default exit for Al. See an opposite bar closing above its midpoint, you can exit your shorts. It doesn't necessarily mean it's a good buy, but you need less of a reason to get out of a trade than to initiate one. So again, reasonable to exit shorts above 70, but not necessarily a great buy. And then maybe you sell 72, low 1, but again, we're getting far from the average price. Climactic, breakout, more climactic bars, probably buyers below 68, and then sort of sideways to up into the close here. And of course, today was a bear trend day. All right, so where do we go tomorrow? So again, here's the daily chart. We have a 2-bar reversal, fairly far above the moving average after a tight trading range, possible final flag. I think it's possible we fall lower, but typically when you get a trend bar, you get bad follow through. It's also an inside bar, so it's possible we fall below today's low for some distance, but also high probability that we come back and test the low of the bar before very long, maybe a couple of bars. Inside bars typically get retested. The bears have the same problem now that the bulls had over here. Spike in channel, channels evolve into trading ranges. Spike in channel, channels evolve into trading ranges. The problem is that the bulls may be discouraged and they may not see value in buying here if you think about the higher time frame context. And let me just bring it up one more time. If we think through what I said about the trader's equation, what if a bear sells the close of today, stop above today, and they're going for 1 times their risk? I don't know if it's 60%, but it might be 55. It's not a terrible trade. And this is such a big disappointment for the bulls that we may get down here before we get back up here. I said the bulls are discouraged. They may not want to buy until we go lower, maybe at the average price, maybe a 50% pullback of this rally. And it's not too much lower, but that is a magnet that the market may be racing to. So even though we had a spike in channel trend today, we may have to fall lower tomorrow. Also, just judge the strength of this bear trend and this bull trend. You'll see this is a lot weaker than this. This is more sustained selling below the moving average, and it's fairly steep. And this was not all that climactic until down here. The breakout was a little climactic, but all of this pretty sustained. Alright, that's all the time I have for today. Thanks for watching, and I hope everyone has a good night.